What a tumultuous start to September. Are we witnessing a repeat of the market chaos from 2020?
Absolutely. With significant declines in the S&P 500, investors need to brace for impact.
In today's episode, we will dissect critical market movements, forecasting for precious metals, and insights from leading analysts. Welcome to Financial Insights in Minutes. We're here to provide you with a condensed summary of today's most impactful financial news.
Stay tuned as we unravel these topics with expert guests, including Vincent Deluard discussing the market turmoil and Gary Wagner exploring trends in gold prices.
Time to navigate through the currents of today's discussion. The market just experienced one of its worst starts to September since 2020.
Yes, and historically, September is notorious as the worst trading month. A staggering $1 trillion was wiped off the market. What does that mean for investors?
So what's the central issue in this market mayhem?
The core thesis suggests that significant pressures on stocks, specifically AI tech stocks, hint at greater market turbulence ahead. With NVIDIA facing antitrust scrutiny, will investors jump back in?
Let's dig deeper. What's happening with these market movements?
Well, NVIDIA is under massive pressure due to potential antitrust cases, resulting in its largest drop since 2020. The S&P 500 just fell over 2.8%, a concerning trend.
And what about historical trading patterns?
Yes, historically, September tends to be negative. And after sell-offs like this, we've often observed the S&P building strength and bouncing back.
Now, what about sector performance? How are others holding up?
Interestingly, financials and utilities are exhibiting resilience while sectors outside of AI tech are outperforming. This indicates that late-cycle investing dynamics are at play.
What are the predictions regarding the upcoming months?
Goldman Sachs suggests a 20% chance of recession in the next year, while the market is pricing it at 38%. History shows recessions often catch markets off guard.
And what about future market performance?
Based on past trends, we might see a potential recovery in the fourth quarter. If indices stabilize, we could witness a strong bull trend later in the cycle.
To sum it all up, what's the overall perspective here?
Despite the bearish nature of September, markets often rebound thereafter, so investors are advised to remain alert, but cautiously optimistic as trends reveal potential for recovery.
Let's dive right in. Today's topic revolves around the curious behavior of banks at the Fed's discount window.
Exactly. The recent trend of banks repaying their loans raises eyebrows, especially when officials are encouraging borrowing.
So what's the main thesis behind this strange behavior?
The core thesis suggests that despite federal encouragement, banks are repaying loans, indicating caution and possibly signaling deeper concerns about economic conditions.
Interesting. Can you break down this banking behavior for us?
Certainly. Banks are opting to repay loans rather than borrowing more, which suggests they are becoming increasingly cautious about the liquidity landscape.
Now, what do these economic indicators tell us?
Stubbornly low treasury yields and plummeting commodity prices create a grim outlook, suggesting the markets are bracing for tougher times ahead.
What's the deal with the stigma surrounding the discount window?
The stigma is real. Banks fear that borrowing from the Fed signals financial weakness, deterring them from utilizing these funds.
What predictions can we make based on this behavior?
These actions suggest looming economic challenges, as banks appear to be preparing for tougher market conditions, possibly even a recession.
To wrap this up, what are the key takeaways?
The bank's shift away from borrowing highlights brewing caution, potentially foreshadowing significant economic adjustments ahead.
What do you think the banks will do next?
We want your thoughts. Are banks bracing for a storm, or is it just a cautious pause? Share in the comments.
Time to navigate through the currents of today's discussion. In a dramatic turn, the stock market faced its worst sell-off since early August. Here to help us chart the course is the savvy Vincent Deluard, Director of Research at StoneX.
This sell-off has ignited heated debates. Could this be the beginning of a bigger crash, or just an overreaction? Let's dive right into the facts.
So, what's the crux of this sell-off? What's really going on under the surface?
The core thesis presented by Deluard suggests this recent market drop isn't just noise, but may foreshadow a significant economic downturn. With investors on edge, it's critical to unpack the reasons behind this volatility.
Let's break down those key points. What's the scoop on the market overview?
Deluard highlights that the market plummeted 4% last week, sending ripples of worry through investor circles. Coupled with sky-high inflation rates, concerns are rapidly increasing.
And inflation, how's it playing into all this?
Here's the full report. Inflation has soared to 8.5%, forcing consumers to tighten their belts. This rising cost of living isn't just numbers, it's hitting everyday people hard.
Now let's talk about investor sentiment. What's brewing there?
Investor fears are palpable. Market volatility is revealing cracks in confidence regarding economic recovery. Investors are starting to believe we may not be out of the woods just yet.
So crystal ball time, what does Deluard predict for the future?
Deluard anticipates further market declines as current trends continue, plus we're likely facing additional pressures stemming from global markets.
Any insights on potential policy changes?
Deluard foresees potential shifts in fiscal policy to address growing economic concerns. Regulatory adjustments might just set the stage for a slower recovery.
Bringing it all together, what's the bigger picture?
Deluard insists this sell-off raises deeper questions about the sustainability of our economic recovery, especially under relentless inflation pressures. Is this just the calm before the storm?
What are your thoughts on this sell-off?
It's a critical moment. Is this the onset of a larger crash or just an overreaction to current events? Let's keep the conversation flowing.
Let's dive right in. Today's hot topic, the fluctuating US dollar and what it means for gold prices.
Absolutely. As we brace ourselves for critical economic data and market shifts, Gary's insights will guide us through the currents, especially with gold hovering near $2,500 an ounce.
So what's the critical message from Gary today? How do the trends in the dollar correlate with gold?
The main thesis focuses on how recent lows in the dollar index suggest more strength for gold, particularly as central banks increase their purchases and rate cuts loom on the horizon.
What's happening with gold prices right now?
Gold is holding strong near $2,500, with central bank demand doubling in July. That's a major bullish signal.
What's the scoop regarding the Fed?
Analysts expect the Fed to cut rates, with a significant chance for a 0.5% cut that could act as a powerful catalyst for gold.
And how's the US dollar holding up?
The dollar index has recently dipped to around 100.50, a low not seen in months. Major implications for gold exist if it falls below 100.
Let's get into some predictions. What's Gary forecasting for gold?
He suggests that given current demand and potential price increases, gold could hit $2,700 by early 2025. That's a bullish outlook.
Any predictions for upcoming price movements?
Analysts expect a surge in gold prices if interest rates are cut. Investors may flock to gold, especially if the dollar continues to weaken.
Wrapping it all up, what's the big takeaway?
The future looks bright for gold as economic pressures mount. Keeping an eye on the Fed and market demand could open significant opportunities ahead.
What do you think about the trend in gold prices? Will they reach new heights?
Share your predictions in the comments. Your insight could spark a great discussion as we navigate these markets.
All right, folks, let's dive right in and unpack the financial turbulence we're seeing this September, a month notoriously known for its market woes.
Yes, historically, September is the worst performing month for the S&P 500. Buckle up as we navigate these choppy waters.
So what's the core thesis here?
The main takeaway is that September marks a troubling trend in market performance, with key sectors like technology and energy experiencing notable declines. This volatility raises concerns about broader economic implications.
Let's break down what's happening in the markets. What numbers should we be watching?
The S&P 500 dropped over 2%, with the Nasdaq falling a staggering 3%. Notably, energy saw declines of about 2.5%, and NVIDIA, one of the tech market leaders, plummeted 10% in one day due to a subpoena.
What about the energy sector? It seems significant changes are brewing.
Absolutely. With crude oil prices falling, there's growing concern about economic stability. The bonds market reacted by performing well, while other stocks struggled.
And how does technical analysis fit into all this?
Well, the daily expected moves are anticipating high volatility. We're seeing signs of bearish divergence, indicating we could expect even more selling pressure.
What are the predictions moving forward?
expect even more volatility ahead. As we analyze upcoming economic data, like employment figures, the market could face further declines.
And the economic data due soon. What should we keep an eye on?
The upcoming employment data will be critical. It will greatly influence market sentiment and potential rebounds.
As we wrap up today's insights, what are the key takeaways?
Investors need to proceed cautiously, as market conditions suggest potential downturns. Staying vigilant on indicators is crucial.
And finally, how can viewers engage with their investments during this time?
Stay informed. What are your strategies in this volatile market? Let's discuss in the comments below.
As we've just seen, the insights shared today highlight the significant volatility in the markets.
Absolutely. Vincent Deluard brings a cautionary tale, emphasizing that this sell-off could signal a more serious economic downturn.
Yet on the flip side, Gary Wagner is seeing glimmers of hope in gold, advocating for its impending rise as the dollar weakens.
That's a classic example of how market sentiment can diverge among experts, proving that investment landscapes are rarely black and white.
Thanks for tuning in to Financial Insights in Minutes. If you found today's discussion valuable, be sure to like and subscribe.
And don't miss out on our upcoming videos where we continue to explore market trends and expert insights.
Until next time, keep your investments informed and wise.